Good morning, everyone. This is Tyler Marr from Western Marketing. We're going to give everybody a few more seconds to get logged in here and join the webinar, and then we'll start from there. Can everybody hear me all right? If anyone can post in the chat, let me know that they can hear me. That'd be greatly appreciated. Matthew, can you hear me all right?
You hear me?
Yep, I can hear you. Perfect.
Cool.
Give everyone about another minute or so to get in, and then we'll get started.
Excuse me.
All right. Good morning, everyone. Let's go ahead and get started. For those of you that don't know me, my name is Tyler Marr. I'm a life and annuities marketer for Western Marketing. I'm joined today by Matthew Mundell from F&G, and we are going to be going over their Performance Pro bonus fixed index annuity. Just a couple things before we get started. This webinar is being recorded, so we will get everyone a copy once the webinar is over and been downloaded. If you do have any questions, feel free to use that chat box, or I'm sorry, the question box. We'll answer as many as we can at the end of the webinar, but any questions you have, feel free to ask them in there. And then lastly, Matthew, I'm going to turn everything over to you and let you take it from there.
Yeah, thank you, Tyler. Appreciate you guys. So my understanding, we originally set this up, we're going to do like an Annuities 101. My understanding is you guys are Annuities 101 out, and it's time for you to start slotting in products. So I'm very, very happy. I was talking to Jim the other day. Happy to be able to talk about our best-selling product today and give you one thing I like to do is I like to give you ideas you can take back to your clients. I'm big on using language, actually, that clients are familiar with. You know, annuities can be kind of a black box in a way, right? People aren't familiar with them. They've heard bad things about them. I like to use language that is familiar with people, and it fits with what maybe other financial instruments that they're using or things that they're familiar with. So you'll see that as we go along. We have some ideas. Like I said, this is our best-selling product we'll talk about today, Performance Pro. It is a bonus accumulation product with a twist, and we'll really we can deep dive afterwards, but I'll tell you kind of what I see and what I hear from top producers and be able to share that with you. That's one of the best things about being a wholesaler is I hear from everybody. And every time I leave the house on a trip or do a webinar, I tend to learn something, and I really love that aspect of it. And I like to turn around and teach that. So it's really fair game. Please don't be bashful. If you are, we can always answer questions afterwards. But again, please don't be shy. Please ask any questions you have. Very, very excited to be here. Thank you, Tyler and team, for the opportunity. So I'm Matthew Mundell, National Accounts Manager on the annuity side. I have to talk about F&G just a little bit. I want to talk about where we are, where we come from, and where we're going. So we've been around for over 60 years. This actually slide is a little outdated. We actually have over 1,200 employees. To give you an idea of context, I was hired during COVID. So August of 2020 was when I was hired. I was employee, I think, 280. Now we have over 1,200 employees. In that time, we've invested over $100 million. Actually, it's close to $120 million. And you'll see, if you've done business with us in the past, or you are looking to do business with us, you'll see that we've really, really improved the not only the client experience, but the agent experience as well. We've modernized our platforms, and we're really meeting the moment in the marketplace. We're very, very proud about that. Along with that, you get our ratings are very, very strong, A- or better across the board. AM Best just upgraded us at the beginning of the year, actually, to A, with an outlook of stable. AM Best, if you look at these ratings agencies, they're the ones that really focus on insurance, the insurance industry and the annuities. So this, I think, is what's the opposite of an omen? A portent, right, for the future of ratings. Looking forward to being A across the board, hopefully in the future here. But everything is up and up on us. We have an incredible portfolio, incredible money manager with Blackstone. We've done a really good job of building our business in a sustainable way, so we can be your carrier of choice moving forward. Now, I think more than anything that represents where we are as a company, we were actually ranked #1 for customer satisfaction by JD Power. That's them surveying actually existing clients. This is actually the first time that an annuity carrier has swept all 5 of these categories. You see on the left-hand side here: product offering, interaction, statements, price, and communication. And I think what's significant about this actually is that we actually increased our score by about 60 points last year versus the year before. We were #2 the year before. We had American Equity. We actually increased our score. 843 out of 1,000 is, that's a good SAT score. Maybe not a good SAT score, but that is a good score out of 1,000 for us on the JD Power rankings. We're very, very proud of this. And the best part of it is, we don't have a captive sales force. Like, you as agents and asset protectors, you are our sales force. So the interactions, the communication, a lot of that's handled by agents. So if you're looking for a carrier, just know that your peers, the people that are also selling F&G and utilizing F&G to protect their clients, are really the best in the industry, and they're recognized as such not only by us, because we are proud of them, but also by by these household names like JD Power. So what you see here is a very colorful slide that shows all of our products that are available. I was talking to Jim, and we're potentially going to do a few of these and talk through different products. But I just want to let you know that these are really top of the market products for everything that they do, right? We have the categories listed here: wealth accumulation, higher income potential, bonuses, non-bonus, leaving a legacy for death benefits, right? Each of these products has their niche. And each of these products, for what they do, are really top of market. We're very intentional when we design products that if there is overlap, that each product has their own unique feature that could help to set them apart. I have a star next to the product we'll talk about today, Performance Pro. It's a 10-year product. I like to think of it as a bonus accumulation product with a why not feature on the back end, right? So the big thing that is going to really grab eyes on this product is there's up to a 15% account value bonus from day one, which means, say you put $100,000 in, and we will add $15,000 from day one. That is in standard states. There are states called light states where the surrender charge is lower, so the bonuses are slightly lower, but still 11% is a very high bonus. Now, truly goes into the account value from day one. I just want to make that distinction because there are lots of bonuses out here, 35% bonuses, 25% bonuses on the marketplace, but they don't function the same way, right? They don't go into the account value. They might go into an income base or something like that, a benefit base. These are true account value bonuses. Day one, the client sees when you deliver that contract to them after it issues, okay? We'll talk about the growth potential in a second. One thing I want to point out about this is kind of the first sales idea is what we call the annuity refinance idea. Okay. Now, I was in mortgages for 10 years. I did about $12 million a month when I quit. A refinance essentially is this, right? When you refinance a mortgage, you're refinancing from a higher rate environment to a lower rate environment, right? You're locking in that lower rate environment until you get that loan paid off. This is sort of the opposite, right? And I don't know if you're keeping up with the market and you're familiar with how annuities are priced right now, but rates are pretty much as high as they've ever been, right? The Treasury, the federal funds rate is over 5%, I believe, last time I checked, right? That gets passed through to rates and very high rates on the annuities. I don't have a crystal ball. I can't predict what's going to happen in the economy or with rate setting in the future, but generally that is a good sign that you're going to have high rates throughout the duration of the contract. So when I say an annuity refinance, what I mean is that, I don't lose my mouse here. What I mean is that whereas a mortgage refinance is buying into a lower interest rate, you're actually allowing clients to buy into a higher interest rate. So if you come across clients that have an existing annuity, our rules are basically if it's 3 years old or older and that bonus you see on the left-hand side there pays off the surrender charges, right? Those walk-away charges, we'll allow them to pay them off with a bonus, maybe even have a little bit on top, and refinance themselves into a much higher rate environment. And one of the things we require when we get a copy of an application to do these replacements is actually a copy of the existing annual statement to show that we have higher rates, and they're very eye-opening, right? The rates are very, very different now. So we are refinancing clients into a higher interest rate environment. That's the first sales idea that I'll give here. Now, this product is built, we like to think of it, and you should think of it as a bonus accumulation product, a top bonus accumulation product in the marketplace here. But it also has what I call why not income rider on the side, right? So the focus is the bonus accumulation, but for only 10 basis points, you get an income rider That income rider includes what's called an impairment multiplier. I'll talk about what that looks like in a second. It's my understanding you guys sell a lot of your Medicare health and things like that, and there are products like that. I think this is a natural bridge for you on that. That feature will be a natural bridge for you for what you're currently selling. Just know, I want to point out how low this is, and I'll show you an example here in a couple slides. But 10 basis points on a $100,000 contract, for example, that is $100. On $1 million, that's $1,000 a year. Because it's tied to an income base, I actually don't think of it as a fee necessarily. I think of it as an insurance premium because you're giving them, a form of insurance on the back end for only 10 basis points. And that includes that big bonus and then the accumulation opportunity as well. Now, I want to point out the option. We have a ton of diversification on this product for accumulation. Like that's really the primary driver beyond the bonus. I want to point out that we currently have the highest, I gotta get this right, the highest S&P annual cap rate, 775, for a bonus product above a 10% bonus. Get account value bonus, day one goes in there for growth. Of an A- or better rated carrier. So we're in a very unique position here where you can potentially have a 15% bonus in the standard state. And if the S&P cap maxes out, another 7.75 on top of that. And I'm going to talk about compound interest in a second. That bonus really helps to kickstart the account value as well. Gold commodity is very popular, right? We have actually people looking at this product that are worried about inflation. They're worried about what's going to happen in the marketplace. They're actually selling this product or looking at this product, and even clients are recommending that their agents look at this product because there is a gold commodity option on there. And then anything underlying you see here is what's called a volatility control strategy. That's probably a conversation for another time, but just know that we have 100% minimum participation rates guaranteed for the life of the contract on everything you see underlined. We also have a 3% fixed interest bucket. So at a minimum, you're talking about potentially a 15% growth, bonus from day one, and then a 3% fixed bucket account value growth after the first year, minus that 10 basis point fee. That's a very, very compelling story. I hear from agents all the time. It's a slam dunk. It's a no-brainer, and clients really resonates with them. So I told you I talk about that impairment multiplier that's tied to the income rider. Remember, the fee on this product is actually only 10 basis points, okay? So 1/10 of 1%. So the way ours works is, what happens is there's an income base on the product. And if a client loses 2 out of 6 ADLs, those activities of daily living you see on the screen, we would potentially double that income amount until the account value reaches 0. So that bonus is important, that growth is important, but potentially we're talking about doubling an amount of money the client would receive. What happens is when the account value reaches 0, it goes back to the original amount. So say a client's getting $10,000 a year from this product. On the income side, we would double that amount. By the way, this is on all of our income products. And it's also available in California, I should say. We double that amount potentially in this situation to $20,000. They could take $20,000 a year out. When the account value reaches 0, it goes back to the $10,000. So that's when I say that fee is actually kind of an insurance premium. I think of it as an insurance premium. It's an insurance premium providing lifetime income. Not only a bonus, great growth potential, but it's also providing this type of benefit to protect your client long-term. Now, it's not true long-term care insurance, but the cool thing about that is it doesn't have the same upfront underwriting. There are a couple requirements, but it does not have the same upfront underwriting, okay? This combination of flexibility, especially because it's in California, I know you guys are in Iowa, but I'm sure there's some agents on the call in California. This type of combination is actually very, very client-friendly. And because it's client-friendly, it's also agent-friendly, right? So you're helping to protect people, helping to protect your reputation as well. The last thing we want to have is to have somebody have to move into a nursing home to be able to access their income or be able to double their income from the product. There are products out there that do require confinement. I used to work in a nursing home in college, and I don't want anybody to have to go to a nursing home unless they absolutely have to, right? So to tell them they have to go to a nursing home to be able to continue that income rider that they've been utilizing on their product, that they've been paying for on their product, or stop the annuity and stay home is not a good deal. I call it a devil's bargain. It's not good. It's a bad shake, right? So again, clients can actually stay home with this product. It's not a confinement waiver. It is it's not a diagnosis waiver either. It is an impairment multiplier. It's tied to losing 2 out of 6 ADLs. I know you guys are gonna have questions about this afterwards. Typically, this feature is the most asked about feature and one of the best selling points of our products. We also have another way we're helping to protect your clients and protect you as you're protecting your clients' assets Three riders are available on all of our fixed index annuities, including this one: home health care, nursing home care, and terminal illness. If a client qualifies under one of these three, even if the contract is in a surrender period, right, and potentially there would be surrender charges for normal withdrawals, we'll allow them to walk away with the entire account value penalty free. Penalty free. So they are not tied to the annuity. I mean, these are really end of life situations, guys. So like we're not forcing them to be tied to the annuity's withdrawal provision. We allow them to walk away with the account value, including bonus and any growth ahead of, if unfortunately one of these happens to your client. It's typical to get two of these. I'll say just from a competitive standpoint, it's typical to get two of these. Terminal illness and nursing home care are the most common, but a lot of carriers actually make you pay for the third one, the home health care. So this is actually a really great combination. It's available for free on all of our products. It's just built in. So I talked about reigniting your retirement with a 15% jump. So I talked about how that 15% bonus or 11% life savings actually goes in the account value from day one. And any growth is actually based on premium paid plus the bonus plus the growth, like compounds off of that. I want to point that out though, because it's important, because it helps us to start at a higher point, right? So my mom, for example, she actually has this contract. I sold her a Performance Pro. She had an old VA. It was essentially in the S&P 500. We pulled it out last year. She had a good amount of growth in the last 20 years, just so it was out of surrender. I was able to deliver her a contract, and it wasn't a huge contract, but I was able to deliver her paperwork, and she was confused because there was a $6,000 additional amount on the account value. And I told her, look, that's because you got a bonus, right? And all of that growth is going to happen on top of the bonus. So people who are, we're kind of in a unique situation as retirees, if you're a retiree, where rates are really high, the stock market is at or close to highs almost every day, it seems like. You can lock that in and give you something ahead of that to help grow and protect from downside, right? That's why we call ourselves asset protectors, and that's what you're doing here. Now, I have a slide here. This is actually just approved, and this is something that you can print off, and we sent out an email actually to the field last week to give you kind of an idea how that compound interest can work. Now, apologize. So this isn't an exact, I'm actually working on one for this product specifically, okay? But this is not an exact match to how this product works. But I want to show you the power of compound interest in a fixed index annuity. Because that's one of the best features of an accumulation side of a fixed index annuity, is that you have downside protection and you are locking yourself in every year, and any growth is based on that. So it's true compound interest. So you see on this, the purple line here is the fixed index annuity. In this case, it has a 10.5% cap rate. That actually aligns with our Accumulator Plus product, which is like a no frills accumulation product. And you see the S&P 500 at the same time period, and you can see the impact of that compound interest. You can see how it goes horizontal up, horizontal up, horizontal up, right? Whereas somebody who is invested into the S&P directly might lose money, right? They might see their account value go down. Now, I'm 38 years old. I just turned 38, and I have plenty of time to retire. When I see those dips go, I see a buying opportunity, and I'm selling stuff on eBay to dump money in, right? And buy more into the market. Like if you're 75 years old though, that's a different story. So you can imagine for this type of product, there's a bonus, and hopefully we get this out in the marketplace soon. That purple line is actually going to start higher than the green line, okay? Because you're getting that bonus to start. So as the S&P, wherever you're indexing grows, you're actually starting that compound interest at a higher level, which is one of the advantages of a bonus annuity, is it helps to kickstart that. Now the rates are going to be lower probably for the life of the contract, but you're kickstarting that compound interest at a higher level. So hopefully that makes sense, and hopefully next time we meet, we'll have a visualization for that for you. Getting back on track after market losses. This, I think, is, especially as you're getting your feet wet, I always tell agents, the next slide I show you, I would print this off. We have copies of it available, the PDF copies. If you have an office, I would frame it and put it on my wall. Actually, my office downstairs, we have a tornado morning. I thought I was going to be there today, but it actually has a framed copy of this as a reminder of the benefits of the downside protection of annuities, right? If you are like a mobile agent, right, and you have a satchel, I would laminate a copy of this and take it with you. And we have a lot of agents who actually do that, and they actually have a copy somewhere in their office, because nobody is thinking about loss in the right way mathematically, I think, right? And maybe people on this call, I have to remind myself this is how this works, right? So if you take a look at the third line down here, if you look on the left-hand side, it says minus 20%, that blue line, percentage of loss, right? That would mean essentially your portfolio has lost 20% in a given year. Now, a lot of people think, well, if the market's back up 20%, my investments are back up 20%, I'm good, right? Well, you're not actually. Mathematically, losses hurt you more than gains help you. Right? So you'd actually have to get back up to 25% just to break even to where you were before. Again, I'm 38 years old. For me, I'm seeing a buying opportunity, but when you're retired and you're looking to protect your assets and you need to have that money work for you, right? This could take 2 years to get back to even, right? And your money essentially becomes worth less than it was before there was a market loss. And people aren't really, I'm telling you, clients, agents, nobody's thinking about this way. This is a powerful, powerful marketing tool, powerful sales concept, and powerful tool for clients to wrap their mind around the importance of the downside protection in annuities. And a bonus can help to make up those losses, right? Now, I give this presentation, a version of this presentation. I gave one 2 days ago. I'm going next week to give another one, right? Week by week, I guess it seems to change, right? It's like this week the market might be down, people's portfolios or 401ks are down. The next week it might be up, right? But if the clients are experiencing loss, this helps to get them back to hopefully where they need to be and protect their assets moving forward. So hopefully this makes sense. We can always talk about this afterwards, but this visualization, I think, is the best marketing piece that we have. And the best thing that helps show you the benefits of the annual lock-ins and the downside protection of an annuity, and helps to show you how a bonus can help you get back to where you were before. A couple years ago, we had people that were looking at the bonus because the S&P was down, right, in 2022. People were looking at this as a way to get themselves back to even and then protect their money, right? Volatility in the marketplace really helps to get people thinking about how to protect from loss. Now, I want to point this out because one of the other benefits of an annuity, I remember I said this as a 10 basis point, 1/10 of 1% fee. I mentioned my mom has this product actually, and she was in a VA. It was performing well, but there were ups and downs, but she was paying about 3.5% fee, right? So I think what's important is when you're talking about how products are built, not every product and every bonus product is built the same way, okay? And it's important. One of the benefits of an annuity is that the fees can be either eliminated or reduced dramatically from mutual funds, a 401k platform, a brokerage platform, or another type of annuity, right? Like a variable annuity and some fixed index annuity. So this is a comparison here of a hypothetical competitor. We're talking about a 15% bonus, 3% fixed interest rate. Now the competitor has a higher bonus, a higher fixed interest rate, but the fee is almost 10 times as much, right? And this is actually, there's a real product out there that looks like this. So ours is 10 basis points. But by the way, with our 10 basis points, you get that income rider, you get the protection of the impairment multiplier. You just get the bonus. It's a higher bonus, right? And remember, we're thinking compound interest, okay? I'm trying to get you guys thinking compound interest. Like, what is the impact of that with just a low, 3.3%? We're basically giving the most conservative growth estimates we can on the product, right? Well, the impact is substantial, right? You can see that here. So with our product, you're talking about an account value potentially growing much higher because that fee is not dragging down the account value in the same way it is when it's 95 basis points, right? We're talking about essentially 1/10 of the fees, even with a smaller premium bonus, and we're talking about a substantial difference in account value and results at the end of those 10 years, the 10-year period. So hopefully everybody's excited. I mean, this is a great product. It's our best-selling product. It's a great recruiting tool, and it's one that it seems to resonate with clients as well, hopefully with yours. Now, we have a QR code on here, and we can send this out afterwards too. I think with this product in particular, we've done a really, really good job. Every slide that you've seen here, you can see in the middle here, we actually have a flyer that essentially matches up with the slide and shows you the value of each feature of the product, including that impairment multiplier. So as a holistic view, this is in my opinion, one of the best value propositions in the marketplace, this annuity. Bonus, accumulation, and then you get a why not income rider that gives you protection on the back end. I forgot to mention this, but 70% of Americans, if you make it to retirement, if you make it to 65, will need some form of long-term care insurance in retirement, okay? Now, again, I have to say this is not long-term care insurance, that multiplier is not, but there are benefits to it. It doesn't have up for underwriting, but it provides a similar type of feature to help protect people, right? It helps protect them in retirement when they need it for a very, very low fee. Great, incredible value proposition. Say hi to compliance, everybody. And then I'm going to put there's compliance. So I'm going to our contact information out here. I'm on the road every week. I'd love to get you, we might get you taken care of if you have any questions. I'd say also reach out to Western Marketing first, but we are always available to help anybody on this call. Get familiar with our products, get familiar with F&G and how we do business. So thank you for your time. Let's see those questions roll in. Anybody got one for me?
Yeah, thank you. Yeah, thank you, Matthew. So right now, I don't see any questions in there yet. We'll open up the floor for a little bit. If anybody has any questions for myself or Matthew, feel free to throw them in there. We do have one. Please go over the health qualifying coverage.
Yeah, let me go back here. And I knew it was going to resonate. I was taking a look at the Western Marketing website ahead of this, and I know what you guys are selling, and I know it would resonate for you. So let me ask you, are you talking about this page? You can type it in the chat too if you're bashful. This page, or are you talking about the impairment multiplier?
So there was a follow-up on it. It says, please go over the health qualifying coverage for the long-term care benefit. Thanks. Now, Matthew, I'll just remind you, this is not a long-term care annuity. So, Matthew, do you want to, but yes, that was the page the agent was referring to.
Yeah, so this would be the focus, and this is a great feature. Is very, you don't have to take my word for it. You can do a competitive analysis. Very, very client friendly, which makes it agent friendly as well. Okay, so again, it's long-term care-ish. It's not long-term care, right? Which can be, depending on the client, can be a good thing or a bad thing. So here's how this works. Okay, not a bad thing, a good thing or a neutral, right? So you see the 6 ADLs here, activities of daily living. If a client loses 2 out of 6 of these, and the contract has been in force for at least 3 years, and they're a single annuitant, right? That means we're protecting 1 life instead of 2. I'll tell you what that looks like in a second. We will double whatever that income base like if it's $10,000, we'll double it to $20,000. As long as the client is alive and the client still qualifies, we'll keep that amount at double. We still can't do 2 out of 6 ADLs. Now, when the account value reaches 0, it exhausts the account value. In this case, we would go back to that $10,000 amount, or we go back to the original amount. So that's the insurance portion of it, is that even if the account value reaches 0, you continue to still receive lifetime income. If it's joint annuitants, say for example they're married. By the way, even on qualified money, we can take joint annuitants after issuance. If it's joint annuitants, it'd be 1.5 times. So in that situation, say the income rider is 10,000, we would 1.5x it to 15,000 until the account value reaches 0, and then go back to the $10,000. Again, it's ADL driven. It does not self-terminate after a certain amount of time. It's just until the account value reaches 0, the client unfortunately passes away. For joint annuitants, and this is a question you have, maybe not asking, but it's a question you have. For joint annuitants, only one needs to qualify. So if, say, one spouse loses 2 out of 6 ADLs, we would be able, let's click on there, sorry. Like a glitch. We would be able to 1.5x those payments. And there's no upfront underwriting necessarily like there is for long-term care insurance. So we see a lot of cases like this. The client is looking for something like this, but they may not qualify, right? Because this is not a diagnosis-driven rider. So we have people with HIV, like Lou Gehrig's disease, like they have diagnoses, but they're otherwise healthy. When they lose the ability to do 2 out of 6 ADLs, they will be able to activate this. And we've had clients do that. Now, excuse me. There are a few exceptions. I think the big one is Alzheimer's, right? So if people have Alzheimer's right now, we most likely won't be able to activate this particular feature of the product. That's just a unique one, right? And if they're currently in a nursing home, they would not be able to activate this either, right? And then if they're currently can't do 2 out of 6 ADLs, we could most likely still issue the contract, especially if they're staying at home right now, but they would not have this available to them. How it works from a underwriting standpoint, I hate to say underwriting, but suitability standpoint, the client's impairment, the loss of the 2 out of 6 ADLs has to start 1 year after the contract issues, and then they can activate this feature after the 3rd anniversary, so the start of the 4th contract year. That's the common timeline for annuities. What we're trying to do is, I forget what it's called, anti-selection, is that what it's called? insurance term, we're trying to avoid that, right? So sick people opening a contract and activating something immediately, a feature like this immediately. So the client, if they're otherwise healthy, even if they have a diagnosis that will at some point impair them, they have to wait 1 year, or that impairment has to start at least 1 year after the contract issues, and then after the third anniversary, they can choose to activate this feature. Now, after the first year, they could actually activate the income rider. They could get income out of the product, and of course, they could take withdrawals too after the first year, the normal 10% free withdrawals. But we will not activate this until after the third anniversary. That's a lot. I know that's a lot, but this is the common way these are structured. So we're not breaking the wheel or anything, but that's how this works.
Perfect. Thank you. We had 2 more questions come in. They're actually both the very similar questions. What is the minimum amount of premium for this product required?
10,000. Great question. Yeah, 10,000. So that'd be what, a $1,500 bonus in the standard state, $1,100 in the light state.
Perfect. And then, yeah, I think any other questions we have from anyone?
I'm gonna tell you. So for that minimum, I'll tell you there's a unique with annuities. There is a unique time period. We've passed it, but it's a new time period every year. Okay, and that is from January 1st until the tax filing deadline. If you can get that business into us before, usually April 15th, you can actually combine IRA amounts. This is a really good sales idea, actually. You combine IRA amounts for 2024 and 2025 next year, and you can do that after January 1st, 2025. Okay, so what you do is you send in a letter with with an explanation of how you want it split with your check. So client can actually combine those 2 years. And if you think of $7,000 is the maximum this year, I believe. That's less than 10,000, but a client could start an IRA and do those 2 contributions simultaneously at the beginning of next year before the tax filing deadline. Hopefully that makes sense. But we see a lot of business coming in, a lot of smaller cases. This year, what was it? 13.5, I think, if you combine 2 years, where people are making contributions for 2 years between January and then the middle of April. So that's a great way to start your business working with annuities, is to look for those type of cases, but also get clients thinking about putting the minimum investment into the annuity and getting their money protected. There's so many ways we can go with this stuff, guys. So I can start nerding out completely. I appreciate the questions. They're great questions.
Yeah, perfect. Well, unless anyone has any other questions, I think that does it for today. If you do have any other questions after this webinar is over, feel free to reach out to myself or any of other Western Marketing's other life and annuity marketers. We'll be available to help you out however we can. But Matthew, I want to thank you for joining us today and putting on this presentation.
Thank you, everybody, for your time. Let's go get them. Have a great day.
Thank you, everyone. Have a great day.